YouTube. So what we're gonna do is a little different format video of what we normally do over here. We're gonna bunch 3 different companies into one video and just compare the overall financials on each individual company that we're gonna go through, which is Pfizer, Moderna, and Novavax. And yeah, we're gonna put those into this spreadsheet, look at the financials, and value what we can. 2 of these companies, 2 of the 3 companies here are not profitable. Pfizer is a profitable company. We can see we have positive forward-looking EPS. When we come over here to Moderna, we can see we have a negative forward-looking EPS, and then also on Novavax, also a negative forward-looking EPS. So we cannot really physically value those 2 companies, but what we can do is look at the financials and see how they are performing. If they're performing in an upward trajectory, then maybe it's worth digging deeper into those 2 companies. But what we will not be doing though is looking too deep into the fundamentals of each one of these companies. Also, full disclosure, I do not own any one of these 3 companies either. So first things first though, what we're going to do is take a look at Pfizer. So this is the one that is profitable. We can see a small little bit of short interest against the company. It is a $168 billion market cap on the company. It does offer 5.6% dividend yield as well. So get a little bit of extra money with your investment on that one. And they also reported their earnings October 31st, beat on their EPS, but missed on their revenue. And with their guidance that the company gave, potentially all analysts have revised their expectations much lower. And same thing with Moderna here. We come over here, we got our negative EPS, a bit more short interest sitting at 6%, only a $43 billion market cap. And then we come over here into the earnings reported on November 2nd, missed on EPS, but beat on revenue. And again, all analysts have revised their expectations lower for in their next quarter. And then over here to Novavax, we've got an EPS, negative EPS, 43% short interest on this one, at a $597 million market cap. And then earning reports beat on top and bottom line, and analysts that cover this company have revised their expectations lower for next quarter. So over here to the financials, we're going to look at Pfizer first, and we're going to scroll over here to our charts. We can kind of take a peek and see how Pfizer is performing. And we can see back in 2020, COVID helped them grow significantly with their vaccines and whatnot. And then obviously they peaked in 2022 and since then have made a very strong U-turn on their overall revenue and financials combined. And we can see they're trending back to probably around this $50 billion revenue range, back to where they used to be, is where it looks like it's potentially headed. Obviously it's coming back quickly, and we don't exactly know where it's going to end up, but we can tell it's coming back down for sure. So gross margins here, I mean, margins just keep getting destroyed. Last quarter is sitting at 30%. Prior to that, we went from about 80% margins down to 60%. So we're seeing a pretty big reduction in overall margins. And then obviously that contributes to net margin contraction as well. But even though with gross margins shrinking the last few years, it looks like they've done a pretty good job. Except for this most recent quarter, we can see last quarter they were negative on their margins. But prior to that, their margins weren't too bad. So maybe this isn't such a bad thing that their gross margins have contracted. It looks like they can carry a lot of that down to their net margins. Then we come down here to return on invested capital, sitting at about 9%. Not bad. Could be better, has been better, but kind of also getting back in line with where it used to be. Sitting about 9 to 13% range. PE sitting at 16.25 today. Cash to short-term debt. They do have more cash and short-term debt, so that's good. But cash to total liabilities definitely a lot more of that than there is of cash. So for me, that is something I always keep an eye on, is to see if they have a strong cash position, if there is a storm that needs to be weathered, that they can weather it or not. Over here to earnings yield, sitting at 6.25%, net income to free cash flow. Again, it's coming back in line with where it kind of used to be. So free cash flow, $8.1 million. Their capital expenditures are not coming back in line where they used to be. They are growing and looking like they're continuing to grow as well. Share count dilution, it's pretty flat. It not really, you're not getting diluted, but doesn't look like they're buying back much for shares either. But their dividend is consistently growing year over year, so that is good if you are a dividend investor. So now the next company we want to take a look at on financials is mRNA. We'll come over here to our charts, and it's a similar story, but only a little bit more dramatic actually. So 2020, fantastic revenue growth and everything. Obviously we know why. We got a pretty good understanding of that. We had the vaccines coming out. So we can see our revenue and our gross profit, net income grew rapidly, really quickly, and since then have completely given all that back and then some, which is a little concerning for sure. You know, you pop all the way up here and then just straight line down and crack well below where you used to be prior to 2020. And then we come down here to our margins. You know, fantastic margins, gross margins. I don't know how they did 100% gross margins, but they did apparently. And it's just kind of just trickling lower and lower and lower, doing it really quickly. Net margin, same thing, negative 198% on net margins. You know, I mean, it's not looking good on mRNA at all. PE ratio sitting at 11. Return on invested capital going to be negative. Cash and short-term debt, so they've got plenty of cash to cover their short-term debt, so that's good. And they've also got plenty of cash to cover total liabilities. So balance sheet looks pretty good. So that is definitely a positive. Definitely looks like that a lot of that positive balance sheet here came from 2020, 21, and 2022 free cash flows that they probably carried over here to their balance sheet. And it looks like they might be soaking through quite a bit of that. Liabilities are getting bought or paid down and they're not growing, but they're also not shrinking as quickly as cash. So obviously we know that the company is burning through cash now and their free cash flow negative as well. So we know the company is not a positive, is not bringing in money, but it is burning through capital. And then we got over here our share count of definitely a positive. If you are a shareholder, you are not seeing dilution. If anything, you're seeing a little bit of some buyback going on. It looks like they used a little bit of this free cash flow they had and bought back some shares. But since then, you're not seeing dilution, but they're not buying back shares either at the moment. So overall, financials on this one, very similar story, just a little bit different. You know, very, very exact same trajectory, just a little more dramatic than where Pfizer ended up. So next on the list, we have Novavax. And on this one, totally different from the other two for a story. I mean, it was growing prior to 2020. However, their net income was doing the complete opposite. It was going in the wrong direction quickly. And in 2021, it just peaked. I mean, you had peak revenue or gross profit and peak negative net income at the same point in time. So they must not have been able to control their SG&A and R&D very well. Yeah, you can see R&D expense right there, $2.5 billion. That could have been a one-time deal. Maybe they had some sort of lawsuit potentially that came into there. You know, maybe that's something worth looking into. You know, whenever you got a big spike like that, so there's usually a reason. There could have been something. Obviously, maybe they tried to jump onto the COVID vaccine hype train. I'm not real sure on that exactly. But obviously, if you were wanting to invest further or dig deeper into this company, probably want to understand maybe what that was about. But we can see, you know, revenue gross profit was good. It's still positive compared to where, you know, Moderna was or is. But we just aren't seeing positive net income yet. We're still burning through cash. So we got gross margins, negative net margins. We come down here to return on invested capital, 155%. Obviously, it's all over the board on this one. I'm not going to base anything off of that. Earnings yield, again, not really worth that. But here's a big negative on this one. This is why this thing's got 45 or 43% short interest. You've got, okay, so you're burning through cash, right? So you're making positive gross profit, but you're burning it all through your SG&A, your R&D, and potentially maybe something else in there as well. So you're utilizing all your cash and then some just to keep the business afloat, you know, to run the business. And on top of it, you got a significantly large amount of short-term debt compared to cash. You have $651 million in cash and $1.4 billion in debt. And then on top of it, you come over to free cash flow and net income, you're burning your negative free cash flow is $700 million. So you've got, in the trailing 12 months, you've lost $700 million. So you've basically got maybe less than 1 year, maybe 3/4 left of cash to go and turn a profit. And you can see they're a pretty good clip away from turning a profit. So, they've got a lot of work to do quickly. And on top of it, they are diluting shareholders quite a lot. You went from 78 million shares to 103 million shares. Probably the next thing to do is to raise more capital. So you're probably going to see more dilution on this one as well. So definitely makes sense to see a pretty large short interest on this. So definitely did not intend to rank these from best to worst on the financials, but that is exactly how they ended up. And if we want to do a real quick comp on all three of them, we can come over here to the comps on the spreadsheet. And again, this spreadsheet is available. There's a link in the description down below if you are interested and want to do this analysis on your own as well for your companies that you want to. Otherwise, what you can do is put in the comments companies you want valued as well, and I'll try to put that together in the future for you as well for future video for everybody to see. But we come down here and we can see gross margins, operating margins. I mean, it's just 1, 2, 3, how we did it in order. And we can just see Pfizer is definitely the leader of the three that we just went through on the financials. So next thing we can do, so we really can't value mRNA or NVAX. So what we're going to do is delete those two off of our multiples comparison. So we won't have a multiples comparison on this valuation. But what we do have, PFE, we can see revenue growth for the next 3 years sitting at about negative 10%, and EPS growth for the next 3 years sitting at about positive 14%. That gives a P to Lynch fair value of $25.80. So no multiples. We do have a manual PE of 20, so it'll take about 20 years for this company to earn its current market cap. So not too bad. It's pretty good. We do have a negative PEG, obviously, because we have negative revenue growth. So that is something we won't be able to utilize. Graham's valuation gives them an intrinsic value of $62.06. Dividend discount model, $30.71. Over here to our DCF valuation. So I have not plugged in any numbers yet. So analysts, if we come over here to Seeking Alpha to give you a little idea of how I do this and go through this, but come over here to the growth tab. Free cash flow per share growth rate, forward looking, they got negative 17% in there. So we're not going to plug that in, but we can just put a 0 in there for now. It doesn't change any numbers, but we can see their average growth rate is 10%. Analysts are expecting negative 17% growth rate. Obviously, we aren't exactly going to know how that's going to play out, but we can look at the trend here. We can see they grew. So I'm expecting to see them potentially get back into pre-2020 levels. So maybe we're still, I would say, potentially a 0% growth on free cash flow. If we're sitting trailing 12 months, about $8 billion, I can probably expect them to be in this range, right? So I'm going to give them a 0%. I'm not going to give them a negative because that would give us that'll give us a negative DCF. So we'll just give them a 0 for free cash flow growth rate if they maintain $8 billion. We're looking at a DCF price per share of $42.75. So down to Rule 72, we want to find our EPS growth rate. So we just saw on the first page, we had 14% growth rate. And if we come over here to Seeking Alpha, we have an EPS growth rate of negative 20%. So again, we're not going to put negatives in here, but we will put a 0. And I'm going to assume that Yahoo is going to be around 0 as well. So that gives us an average growth rate of about 4.7% forward looking here. So I think 4.7% seems pretty fair. So that's going to give us basically a half for a double on our EPS. So we're going to look at maybe like 2.5 for a future EPS on this company. So with that, our fair value is going to be $5.88. So this is maybe one of those I'm not going to put in here for final valuation, just because it's not going to, it's going to really dilute what we're trying to do here. So sometimes when you go through these calculators, they just don't compute to a good valuation. Like obviously you don't want to skew it one way or the other, but when you get 62 and you're trading at 23 or 30 there, okay, maybe, but you got your dividend discount model sitting at 30, you're trading at 30. Okay, that makes sense. And then your DCF, gives them 42.75. It makes sense. You got to make some judgment on this as well. So maybe we can leave this in here to offset that 60 that we got on our Graham's valuation at $62 per share. So maybe that'll offset it. So I haven't even seen the final valuation on this, so we're going to both see this at the same time. So based on what we just did on our valuation, we're getting a fair market value of $33.44 on Pfizer, and analysts have a price target of $40. Now, one thing I always never do is base my or try to skew my analysis to get close to where analysts are, because I don't know where they got their numbers from or what they're forecasting. But one thing I know for sure is I know where I got my numbers from and the financials that I saw, and this is the fair market value that I am comfortable giving this company. So that's my fair market value on Pfizer is $33.44. A 30% margin of safety is sitting at $23.41. So this would be roughly my buy range is about $23. If it's a really good company, I really like the financials, I'll cut this down to like 10% sometimes, or sometimes I'll just maybe buy it at a fair market value as well, depending on how much I like it and what the growth rate is on the business as well. But overall, you know, we're slightly under where analysts are, and I'm totally okay with that. I just like to put this in here to get an idea of where they're thinking it's going to be as well, and then I can see, okay, I'm close, or if I'm super far away, then maybe that's worth digging into differently, or digging into more, and figuring out why I'm so far different. But in this case, we're close enough, not going to worry about it. So that's where we're at. One thing we can do if we wanted is we can plug in forward-looking numbers on this company as well, forward-looking PE and our forward-looking EPS. We can see if it's even going to be that much different. So we got forward EPS of $1.53 and PE of 19.45. So if we plug those two in, it's only going to make it worse. So we're not even going to bother too much with that. So forward-looking numbers, though, you know, that's what we're looking at. We're looking at $30. So we plugged in forward-looking numbers that we pulled in from Seeking Alpha here. So EPS went down and our PE ratio went up. So we're sitting at $30.60 fair market value forward-looking, and purchase price $21.45. So now over here to our stock chart on Pfizer, the one that I would consider spending more time investing into to dig deeper and understand this company more. So of the three anyway, you know, the other two I wouldn't personally do too much with, but obviously do with that what you want. But what we're looking at here on Pfizer here, so we've got three different trend lines drawn in, and then we're on the weekly chart here. Obviously, you can drill down to a smaller time frame if you want. Weekly chart, you know, I try to connect as many of these dots here as I could. Obviously, this one's kind of cutting some of that one out there. But for right now, Pfizer bounced off of support. We can see we got this purple line drawn in here, and we've got quite a bit of support in this range, a lot of consolidation. And every time we come into this $24, $25 range, we bounce up higher. So we did just that recently, but we're still in this very steep downtrend. Bounced off support, ran into resistance, got rejected at resistance, peaked through a little bit, but looking like we're failing again. So, you know, who knows what's going to happen exactly with this, but because of the financials, because of the outlook, a lot of it is probably priced in already. So we're probably still going to just chop around down here. Maybe we'll finish out this wedge, and maybe in the future here, financials will start turning around. Maybe they'll come out with their new drug or whatever the case may be. Financials will start turning around, and we'll start seeing them pop up back up higher. You know, get out of this channel, get out of this downtrend that they have been locked in for, you know, since really probably, I guess, you know, beginning of 2023. So they've been just locked in this downtrend for over a year now. And they're, you know, maybe finally getting to the end of this wedge, and then they make their breakout higher, and maybe they retest this long-term blue trend line that I've got drawn in here that goes all the way back to 2010. You know, every time it hits this blue line, it bounced up higher, hits the blue line, continues to bounce up off of it, but since recently has broken through and sustained the breakthrough. And is not, you know, the best case scenario on this is it's going to could potentially come back up, retest. You know, analysts have their price target at $40 per share conveniently at the back test of this line. You know, that's the other thing too with analysts. Sometimes I think they try to make it seem like it's a good deal and trying to get, like, you know, just, you know, retail traders to buy into it because their analysts' expectations is $40 per share. But you're blindly buying it then when you just base your purchase off of somebody else's analysis. It's kind of the same thing I'm doing, but you can at least see where I'm coming from and understand what I'm doing, and then maybe that makes you feel better about it. But again, don't buy it just because what I'm saying either. You should always do your own due diligence. And again, this is not financial advice. This is just my analysis on this company and these three companies, really, and my opinion. So if you found value in this video, drop a like, subscribe, comment, and if you want any other stocks valued, also drop that in the comments below. If you like this type of video where I kind of consolidate a few of them together, also let me know if that's something that you enjoy. I'm just trying something different here, see how it works and see if people like it. I kind of enjoy it. I find it fun to look at several at once versus just one simple company, and then kind of compare a group and see how the group does and see which one is worth spending more time and figuring out if it's worth investing into or not. But that is it for this one. Again, found value, drop a like, subscribe, comment, and back later with another stock analysis video.